All right, thanks everybody. Good morning and welcome to this update. Today we're going to discuss a binding private ruling for a change. I actually didn't want to cover it at all, but decided let's take a break from the judgments. There is a particular judgment which I will discuss next week, which is, I think, of a little bit more general application and will find wider reach. This particular ruling is very fact specific. It's a very unique transaction. And the reason we cover binding private rulings, and I'll say this every time I discuss a binding private ruling, I'm going to explain why I discuss them, because even though binding private rulings are only binding on SARS in relation to the applicant, we nevertheless look at them because they give us a good idea as to how SARS looks at a particular set of facts. Now, the trouble is with these binding private rulings, at least the published versions of them, is they are heavily sanitized, right? And so when you read a binding private ruling, you often go through it and you go, obviously, or why, or okay, so what? And the reason you have those issues with binding private rulings is because they are heavily sanitized. And so when you read them and you want to actually learn from them, you have to sit back and ask yourself a question. First of all, what is the risk that these people tried to cover off? What tax risk was there that warranted the application to SARS for a binding private ruling? Where was the uncertainty? As soon as you start asking that question, you will find the ruling starts getting a little bit more value, right? You'll find that you'll learn a little bit more out of the ruling, and that's why we cover binding private rulings, even though they are not binding on those of us who are not parties to the application. Right. As per usual, this training is intended for my staff. For those of you joining online, it is for your interest only. Right. So, quickly, the facts of this case. Well, we won't be long. I don't want to cover it in too much detail. But the facts of this case is quite unique. You've got the applicant who's the South African taxpayer, right? And there's this foreign company, Company A. And what this foreign company is going to do is it's going to go on a fundraising exercise to raise funds. And a percentage of the funds that it raises, it's going to use a percentage of that funds to subscribe for shares in the South African taxpayer, right? Right? But the trouble is there's no fixed amount, because the amount of subscription proceeds it'll pay depends on how much funds it raises. Also, the shares will not be issued to the foreign company immediately. It will be issued to a stakeholder who will hold it kind of in escrow until the ruling isn't clear as to whether or not the shares will release as the subscription proceeds gets paid, as Company A raises funds. But we know that it goes into escrow and presumably it will be released. But there's a cap. But there's no future exact payment date for the subscription proceeds. It is as and when Company A raises finance, and if Company A raises finance up to a capped amount, right? So they call this a delayed contribution equity investment scheme, right? And so the company will then issue the shares as and when the payments come in, but it goes to escrow, but it's not clear when the shares are released to the actual foreign company, right? So this is clearly a fairly odd setup. Right? Or not odd, I should say. It's odd in the sense that it's not something you come across often. Now, the ruling deals with the applicant's ability to deduct R&D expenses. That's what this ruling is about, right? And whether or not this money that the company is getting from this foreign company, whether or not it's share capital, because it has this odd flavor. But if you look at this transaction, you know, if this were a normal equity contribution, we would not be asking questions about, is this contribution contributed tax capital? Is the expenses incurred with this contributed tax capital or share capital, is it deductible? It would be a fairly vanilla transaction, and we would not be asking these questions. And the only reason I suspect, and we don't know, right, but this is where we start speculating a little bit so that we can get value out of the ruling. The only reason I think that they went for it is because of this strange way of the shares being issued over time, but not a specific amount depending on the percentage that's raised. It looks different to a normal, I give you R1 million, you give me 1,000 shares, right? It is, I raise funding, depending on how much I raise, a percentage of that I'll pay to you. There's no fixed terms of payment, right? And the funds are held in, or the shares are held in escrow and then released to me over time, so it looks a bit odd. Right, and so the ruling that they went for is they asked SARS to rule on a couple of things. Now, for those of you not familiar with ruling applications, we've done many, but you can look at where the taxpayer was considered or considered themselves at risk by looking at the ruling SARS granted, because that's what they asked for, right? when you go for a ruling, you must ask SARS, I want you to rule this, 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 and this. And the reason, the way you choose the things that you want SARS to rule on is where you think the risks are, right? Where you think a SARS auditor might disagree or might raise an issue with you going forward. Right, so SARS ruled on this transaction, or the taxpayer asked, is that the accrual for the applicant of these contributions that it receives, the accrual is in each year that company A secures the funding, right, equal to the agreed percentage. So if company A gets £1 million worth of funding and we say 10% is what we'll subscribe for equity shares, then 100,000 Rand accrues at the point in time company A raises the funding, because that's when your entitlement comes in, presumably, right? So the timing is the first thing they were worried about, is when does this proceeds on these subscription shares, when does it fall into my, or can it potentially fall into my income? Because the next question deals with, is it income or is it capital, right? So, and the reason they asked this question, and again, I'm speculating, and we should be fortunate enough that I understand that the guy who did this ruling application is on the call. And maybe Kulani, I think it was, is your name, and maybe we'll come to you at the end and you can give us some comments, because these rulings are very sanitized. But the risk obviously was is they were worried that if there's a capped amount that they have to subscribe to, SARS could say, but the full cap accrues to you on day one, right? It depends on how the contracts read, but they were clearly concerned about that, or said, well, that might be an issue, so let's just get confirmation from SARS. And this is something that's crucial, right? I still believe that rulings is one of the most efficient ways of managing tax risks, because it's the only way, short of getting a declaratory order from the High Court, which is not easy, of getting absolute certainty as to what your tax treatment will be on a transaction, right? And that's why people go for these rulings. Right, the next thing they asked SARS to rule is that these amounts that it receives as a percentage of the funding that the foreigner raises, this is not gross income, this is a capital receipt, right? So SARS said, yes, that's a capital receipt, and SARS could say, but look, this looks to me a little bit like you are, and that's where I think the risk comes in. This looks a little bit to me like somebody's paying you to do this, right? This is not a vanilla, I'm putting equity in the company and you develop it, and it's your IP and you own it and you sell it. It looks like somebody's funding it. It looks like company A is paying you to do this, right? Which might suggest that it's revenue in my hand. So they said, let's just get confirmation from SARS that this, although it looks odd, this is a normal equity share subscription transaction, right? And SARS said, well, each amount that accrues will constitute contributed tax capital, right? And that's important because we want to know what the contributed tax capital is at what point in time, right? Because we can make distributions out of contributed tax capital. If we don't know what it is at a particular point in time, we won't be able to distribute out of it, and we want to make sure that SARS agrees that this is money paid for shares, which makes it contributed tax capital. SARS confirmed that 11D2, in other words, the company, the applicant who gets the money, is entitled to the deduction, provided it satisfies all the requirements, right? It did apply for approval from the Department of somewhere, I don't know what the department is, but you have to also apply for approval to get the 11D. They have applied. The ruling is an in-principle ruling to say you qualify for the deduction, despite the fact that this looks like somebody else is funding it and it's actually someone else's R&D, right? That's effectively, in my mind, why these guys went for the ruling. They said you can get the 11D, that's fine, in the year in which the expenses incurred. But importantly, SARS says they're not going to rule on every R&D item in particular. They're saying at a principle level, this is fine, right? It doesn't affect this strange funding scheme, does not affect the R&D deductibility. Because remember, as soon as you've got funded R&D, right, or outsourced R&D, there's all sorts of rules that come into play, right, as to who can claim what they can claim, blah, et cetera, and this looks like that, right? That's why these guys went for the ruling, right? So SARS's rule, that's fine. Also, something important that they went and that I think was good for them to cover in the ruling, even though it kind of follows, but you want something in writing if you're going to go for a ruling on this, is an important question is, if company A, or not company A, the applicant, let's say they go and they use funding from elsewhere to do some R&D work, right? And this money comes in afterwards, and they use that to kind of cover the cost. That could look like a recoupment under Section 84A, right? And that's what they said to SARS. This is not a recoup, this is share capital. I'm just putting it in a weird way, right? But this is not a recoupment of the expense, and SARS ruled that's fine. What was important, I think, in this ruling is the fact that it's the applicant and not Company A that controls the entire R&D process. They decide what they want to do, how they want to do it. That's crucial because that suggests who is the actual developer of the IP that's being developed here. Right, and I think that was crucial to SARS eventually ruling in the way they did. Certain anti-avoidance provisions or limitation provisions that apply to outsourced or funded R&D don't apply, and the ruling is valid for about 2 years. Right. So I think, like I said, I don't want to cover this into too much detail because it is a fairly unique transaction, but the facts that make this ruling, I think, defensible, or the key facts that stand out to me when I look at this, and bear in mind, I don't have the full version of the ruling. The full version of the ruling is normally several pages long. The published version is like 2 or 3 pages long, right? But as far as I can deduce, key facts is the shares are held by the stakeholder until Company A fulfill its obligations, because there's this escrow account. Each tranche is credited to the share capital as and when they make payments. So I said, yeah, that looks like a share capital contribution or equity contribution. IP ownership remains in the applicant. There's no fixed dates of payments. That helped, because that suggests it's not I deliver a service, you pay me for it kind of thing. There's no fixed terms of repayment or fixed terms of payment. Applicant controls the process, and Company A acquires shareholder rights only, and not the R&D deliverables or the IP. And I think that's why SARS ultimately ruled and said, okay, look, this is fine. This is proper equity. This is not an R&D service that's being rendered, even though it might, if you look at it coldly from the outside, it might look like a simulated transaction to pay for R&D, right, services. And I think that's why these guys went for the ruling. And as far as I can tell, they got what they asked for, and I think that was a sensible approach in the circumstances, especially if you're talking about large sums of money, right? Going for rulings, I've done many, and it is a very, very useful tool. A common misperception, I think, for those of you joining online, is just to point out, is there's this common misperception that SARS will always only rule in their favor. Now, it is true that SARS looks at things in a very conservative way, but I have had many rulings where SARS ruled in my favor, because the facts obviously supported it. But it's different with the rulings team, you know, the advanced tax ruling guys, is they tend to look at the law and not so much what the assessment could potentially be. At least that's my experience with the ruling guys. So taxpayers tend to say, I'm not going to tell SARS about this transaction and ask them to rule on it, because they will rule whatever fits their pocket. And in my experience, that's not true. All right. So this binding private ruling tells us that the taxpayer felt vulnerable in some way. They were uncertain as to the tax treatment. And they wanted to make sure that they don't get a surprise from SARS, because rulings give you certainty. In the context, there was some vulnerability, presumably, or potentially. SARS could say this is, you're paying for R&D services, and the ruling protects them against that effectively, right? And it's valid for 2 years. So, and the benefit of this is, if an auditor comes along, right? Let's say the taxpayer now treats it like this, right? This applicant here, and an auditor comes along next week, and they look at this fundraising and say, this looks to me like outsourced R&D, or this looks to me like funded R&D. Say, I know it looks like it, but here's a ruling from head office, so go away. Right? That's the point. That's why you go for rulings. That gives you certainty.